Module 5, Infrastructure Financing and Investment Models. 1. The importance of infrastructure. Financing infrastructure financing is the backbone of development because infrastructure assets require large upfront capital investment before any return is realized. For example, a power plant may cost billions before generating electricity revenues. Long gestation periods since infrastructure projects may take 5 to 20 years before reaching maturity. High maintenance and operating costs, requiring sustainable financing even post-construction. Risk mitigation strategies to ensure financial sustainability in the face of currency fluctuations, inflation, corruption, policy instability, or technological disruption. Without robust financing models, even the best national infrastructure plans remain unrealized. 2. Traditional models of infrastructure. Financing. Historically, governments have been the primary financiers of infrastructure. This was largely through public budget allocations, tax revenues, oil rents, or state income used for building roads, schools, hospitals, and railways. Sovereign borrowing, public debt. Governments issued bonds or took loans from development banks to finance large projects. International aid and grants. Bilateral and multilateral donors provided concessional finance for infrastructure, especially in developing nations. However, public financing alone became inadequate due to budget deficits, rising debt burdens, and competing social needs, education, health, security. This gave rise to innovative investment models. 3. Contemporary infrastructure investment models. A. Public-private partnerships, PPPs. A PPP is a contractual agreement between the public sector and private investors for financing, building, and operating infrastructure. BOT, Build, Operate, Transfer. Private sector builds and operates infrastructure for a set period before transferring it to the government. BOOT, Build, Own, Operate, Transfer. Private sector owns the facility during concession before eventual transfer. DBFO, Design, Build, Finance, Operate. Private entity designs, builds, finances, and operates infrastructure under contract. PPPs allow risk-sharing, efficiency, and innovation, but require strong legal and regulatory frameworks to prevent exploitation. B. Private sector financing. Private investors fund infrastructure projects directly, especially in profitable sectors like telecommunications, renewable energy, and logistics hubs. Sources include commercial bank lending, corporate bonds. Institutional investors, pension funds, insurance companies, sovereign wealth funds. C. Multilateral development banks, MDBs, and international finance institutions, IFIs. The World Bank, African Development Bank, AFDB, Asian Development Bank, ADB, provide loans, guarantees, and technical expertise. MDBs play a catalytic role by reducing project risks and mobilizing private capital. 4. Innovative and emerging financing mechanisms. Blended finance, combining concessional donor funding with private investment to de-risk infrastructure. Impact investing. Investors seek financial returns while achieving social environmental goals, e.g., hospitals, schools. Digital financing platforms, crowdfunding. Small-scale pooling of resources for localized infrastructure, common in renewable energy. Crypto financing and tokenization of infrastructure assets. An experimental frontier where blockchain is used to fractionalize ownership of projects. 5. Challenges of infrastructure financing, high perceived risks. Political instability, corruption, and weak institutions discourage investors. Debt sustainability concerns, over-reliance on external borrowing risks, debt traps. Currency fluctuations, projects funded in foreign currencies but earning revenue in local currencies face financial strain. Governance failures, mismanagement, opaque procurement, and lack of accountability undermine confidence. Limited domestic capital markets. Many developing nations lack vibrant bond markets to mobilize long-term funds. 6. Case studies in infrastructure financing, China's Belt and Road Initiative, BRI, massive global infrastructure financed through state loans and Chinese banks. Nigeria's Sukuk bonds, Islamic finance instruments used to fund road construction. Kenya's Standard Gauge Railway, funded largely by Chinese loans, raising debates about debt sustainability. Renewable energy projects in Europe. financed through green bonds and blended finance. 7. Policy recommendations for sustainable infrastructure financing. Develop robust PPP frameworks with transparency and accountability. Strengthen domestic capital markets to mobilize local long-term financing. Embrace green finance and climate funding to attract sustainable investments. Improve governance, risk management, and investor protection mechanisms. Foster regional financing mechanisms like the African Union's proposed infrastructure fund. Encourage diaspora participation and leverage technology-driven financing models.